probably seen Tom Selleck selling reverse mortgages on the TV. If so, you may be wondering, what's a reverse mortgage? How do they work? Are they right for me or my parents? And what are the risks? Hey, I'm Rebecca. Thanks for joining me on the Mama Lorian Way, where I'm really just a mom learning about money, learning about how money works, and I like to share what I find out with y'all. Today, I want to talk about reverse mortgages and whether they may be right for you or maybe your parents. And today, I'm in my mom's backyard. It's the only place I had sunlight. So I'm going to answer probably the top 5 questions about reverse mortgages. Number 1. What is a reverse mortgage? Well, they're also called HECM, Home Equity Conversion Mortgage. You don't need to know what that stands for necessarily, just know interchangeable term reverse mortgage with HECM. First of all, say what is a conventional mortgage? Well, you want to go buy a house. The house costs $200,000. You have $50,000. You got to come up with $150,000. You get a loan. This loan is called a mortgage because the house itself secures the loan to buy the house, and you pay it off over 15 to 30 years. 15 years, 30 years, or pay off early. Awesome. And with that, your $150,000 balance goes down over the course of the loan. Well, in a reverse mortgage, say you have your $200,000 house, you own it free and clear, and then you want to take money out. So I'm going to use that $150,000 example. Take out $150,000 and the balance increases over time because of interest and fees. So say you take out $150,000, but over 10 years it might end up being $200,000 because the interest accrues over time and it becomes bigger. The other thing with reverse mortgages is you have to pay the balance of the loan, whatever it is, when you leave the house. And you either leave the house by one of 3 ways. This may sound crass. Death, leaving the house to move somewhere else like an assisted living facility or another, maybe a downsizing, or you sell the house. When the house is sold, the sales price of the house covers the loan. If there's anything left over, you get back in equity. The other thing with reverse mortgages is if the person dies, the homeowner dies, the heirs are responsible for selling the house. The sale of the house again repays the loan and the interest and the fees, and then the heirs get whatever might be left in the equity. Who qualifies for a home equity loan? Well, it's definitely for older people. You have to be at least 62. Both spouses, if there's 2 spouses on the loan, both need to be 62 years old. Must own the house free and clear. You must be able to keep up on your insurance and your taxes and the maintenance of the house. You need to live in it. It needs to be your primary residence at least 6 months out of the year. You can't have any IRS debt, and I'm going to say your house probably needs to be worth more than $100,000 just to qualify. And you do have to qualify, have a good enough credit score. Number 3 question, would a reverse mortgage work for me or my parents? Well, it might if they still want to live in the home because that's a requirement. It might if there's enough equity in the home. It might work if it's not the sole source of income for them and if there's other ways of pulling retirement money out, or if the house has a lot of equity and that's really the only place that there's money to draw out of. One of the good things, and it's a protection, is the borrower, the homeowner, or the heirs to the house are not responsible for any loan that's outstanding over the sales price of the home. So say, make it real simple, say there was a house that they had $200,000 appraised, but the loan ended up being $220,000 when the house needed to be sold. The house only sold for $200,000. The heirs or the borrower are not responsible for that extra $20,000. Or if the house even sells for less, maybe it's 95% of the appraised sales price of the house. So there is a little bit of protection, so it's not going to be extravagantly, there won't be an extravagant debt for the heirs to inherit if, say, the owner lives in the house for quite a long time and the debt just goes up and up and up. All right, number 4, how does this work? And this may be the craziest thing, people don't know how it works. All right, so say you've got a house that's $400,000. you get approved for $200,000 of equity that you can pull out. And you can do it one of a few ways. You can either, one, take it out in a lump sum. Then you will be paying on the interest over time. So like an annual amount of interest payments plus your lump sum, which makes your balance go up. You might choose to get a set amount of monthly payments, like say $1,000 a month, for as long as you live in the home. Or you might do a combo platter of lump sum and monthly payments. Or you could take a line of credit. And a line of credit is a little bit like a lump sum. And you can mix and match all of these. Little bit of a lump sum, but you may not take it out all at once. So say you get a $200,000 line of credit. You might take out $20,000 for some big expense that you have one year, maybe nothing in the next year, maybe $15,000 the next year, until you come up to your $200,000. Now, I'm going to show you an amortization schedule or a mortgage calculator just to see what these numbers look like. So I'm going to share my screen. All right, so I am on a website called mortgagecalculator.org on the reverse mortgage calculator. So in this, let's talk about, say it's a $200,000 mortgage that you get. Say you get a lump sum advance, and we'll do this simple a couple different ways because I like to do the numbers. I hope you guys can see this. If not, we can expand it. Over the course of, say, 10 years, so you have no advance. So lump sum advance, you get the whole thing up front. And you're estimating you'll be in the house or you'll sell the house. Something will happen in 10 years. I got this interest rate as of July 28th, 2022, 3.56. So the interest rates on these are a little higher than your regular mortgage. Calculate your estimated total if you were to take out lump sum advance for 10 years. You'd have to pay back $285,000. What if you wanted to take just $20,000 out, and you can play around with numbers all day you want. Monthly loan advance, say you did want $1,000 a month. Let's see what that would look like. So a little bit less, you've probably gotten less over 10 years. This might be a way to get something out that you need to pay for right now and then have a little bit to use for living expenses. The lump sum can also be thought of as a line of credit, so you could pull out, $20,000, and then over time maybe you need to pull out another $40,000, and it's going to be on a variable rate. So you got no lump sum amount out, but you needed maybe $3,000 a month. Your estimated total back, oh my goodness, $432,000. So be careful with that, because I guess it goes up quite a bit. That's $3,000, $36,000. Oh yes, $360,000. But the cost of that $360,000 for 10 years is whatever, 432 minus 360. You do have to pay back more than what you've gotten out. It's a loan, and you're paying interest and fees. I hope that makes sense. If you want to go play with some stuff, mortgagecalculator.org. Lastly, what are the risks? What are the risks? First of all, these loans have costs associated with them. Sometimes they could be as much as like $5,000 just as a loan origination fee. So that's going to be added in. If you have a loan that's $200,000, you may be paying back $205,000, and a lot of times, I'll tell you this, you'll have to pay interest on that loan origination fee unless you paid it up front. There's other fees, even the mortgage counseling fee is, I think, is about $125 as of this video, and there may be other costs, and sometimes these documents are a little tricky to read. That's why there's a counseling thing. I would not make it any advice, but it's always good to have second pair of eyes, a lawyer or somebody you trust, look at the contract for any kinds of fees. Another risk, temptation. What if all of a sudden you had $200,000 in your bank account? It's not uncommon to want to go spend it, especially if you haven't had that before and you're not real sure how to budget. Sometimes people will use that money for an investment because it could be a really good thing. Pull it out, put it in an investment that pays something. Now you're making your money work for you. Great idea. Make sure you know what the investment is, and it's really good. If you lose the money in the investment, now you've lost your money and you don't have your house anymore. Another risk is inflation. So say you have a set amount that you've budgeted for your living expenses, and it works for you now in 2021. But in 2031, when inflation has gone up 12%, is your dollar going as far? And can you still maintain your house with those payments? And you don't want to lose your house because you can't pay taxes hopefully after 65, you put a cap on that. But maintenance and insurance definitely will still continue to go up. So inflation is a concern. Biggest thing to consider, though, is unexpected events. Like all of a sudden you need to pay something. A lot of times when we're older, it's healthcare. Maybe you have a health scare and end up in the hospital or in an assisted living home for a few months, and then the house looks like it's unoccupied or is unoccupied for a certain amount of time. The bank can foreclose on it. If you run into unexpected events and you can't pay your taxes, you can't pay your insurance, you can't upkeep the house, the bank may foreclose on it. Those are the risks. And then a couple more things. If you are on Medicaid, there is a certain limit that you can have as liquid assets, and pulling money out of your home equity may make you ineligible for Medicaid. Lastly, spousal eviction. If both spouses are not on the mortgage, one of them dies who was on the mortgage, the other spouse is either liable to pay back the entire loan, sell the house to pay back the entire loan, or maybe even forced into foreclosure and eviction. Whew! Scary stuff sometimes. Anyways, as always, do your homework. Look into if something like this financial tool might be good for you or your parents or somebody you know down the line. And leave comments, like, subscribe. I appreciate you. Hope you appreciate me. Mwah.